If you've been trading for a while and you actually take some time to observe the charts, especially with the moving average applied, I'm sure you've seen this pattern many times. And most of the time, you've probably seen it work beautifully. But my question is, have you ever actually traded this pattern yourself? What if we spot a morning star pattern right on the 9-period simple moving average and take a buy trade from there? This question might sound simple, but the answer, it's much deeper than you think. So, let's find the answer in this short video. Make sure you watch till the end, and if you enjoy it, don't forget to like and subscribe. To find the answer to this question, first we need to mathematically calculate its winning ratio, how the morning star performs when we take trades blindly, wherever it appears on the chart. Then we'll see what happens when we take trades only from key areas, like a trend line, a moving average, or a support zone. And besides that, we also need to understand how we're taking those trades, because there are many different ways to trade the morning star pattern. Once we break all that down step by step, you'll notice how the results start to change. And when we add more factors, like trading during high momentum sessions or adding extra confirmations, the accuracy improves even further. After that, we'll discuss how professional traders actually use the morning star pattern and how they turn it from a simple reversal candle into a high probability trading setup. The morning star pattern carries a much deeper meaning than the bullish engulfing, hammer, or other common patterns. In a bullish engulfing, it simply means that buyers have outnumbered sellers, and the price may move higher. The same goes for the hammer. Buyers are pushing the market upward, but the morning star tells a much deeper story. The morning star pattern shows that sellers were initially pushing the market downward. Then, a doji, or an indecision candle appears, indicating that buyers and sellers are now balanced. The market has entered a neutral zone. Finally, buyers step in with strength and push the price back up, marking the start of a potential reversal. Here, the market has 3 possible buying scenarios. The first one, there's about a 25% chance, is that the market goes straight up from the open zone without any pullback. The second, and most common scenario with around a 50% probability, is that the market slightly moves down to retest the previous bullish candle, where buyers are already active. And the third scenario, again about a 25% chance, is that the market reacts from the previous doji candle, rejects from that zone, and then pushes upward. So, how can you trade the morning star pattern in the best possible way? Well, it really depends on the situation. If the market is in strong upward momentum and forms a morning star pattern, you can take a trade immediately after the pattern completes. But if it appears near a support level, it's better to wait for the price to pull back toward the previous bullish candle before entering. And if you're scalping, you can use the doji zone as your entry point, keeping a very tight stop loss. However, the best scenario overall is to wait for the price to retrace to around the 50% level of the morning star pattern before entering your trade. So now, let's find out, mathematically, what happens if we trade the morning star pattern blindly, wherever it appears on the chart. When tested this way, the win rate comes out to be around 60%. Not bad, right? But here's the truth. That doesn't mean we can take every single trade we see, because there are many factors involved. Things like broker spreads, execution speed, volatility, market timing, and even the type of morning star that forms. Some are strong reversals, others are weak pullbacks. And when you combine all these variables, it becomes clear that trading this pattern blindly isn't a reliable strategy. To make it truly profitable, we need proper context, confirmation, and timing. That's what turns this simple pattern into a high probability setup. And here's the interesting part. Even if we trade this pattern on a trend line or a support zone, the win rate still stays around the same, close to 60%. Why? Because these are the areas where smart money often hunts stop losses or liquidates early buyers. And since the morning star is a strong reversal pattern, many traders enter their buy positions right at these key zones. But what usually happens? The market dips below those levels to grab liquidity before making the real move. That's why, even at support or trendline levels, the win rate doesn't improve much. It still hovers around that same 60% mark. So now, let's move to our strategy and see what happens when we bring in the 9-period simple moving average. When we start taking trades, only when the morning star pattern forms above this moving average. As I mentioned at the start, the answer is much deeper than you think. The reason is simple. To make this strategy powerful enough to reach a 75% or even 80% win rate, we need to find these exact types of setups. So the question is, How and when can we find them? To get profits from this market, or to become a profitable trader, to achieve a 75 to 80% win rate with this strategy, first, you need to trade during high volatility sessions, like the London session, the New York session, or the overlap between both. Then, you need to stick with one pair so you can understand its behavior deeply. After that, wait for momentum. If the market gives a strong push to the upside, wait for it to come back and test the moving average. When it forms a morning star pattern there, that's your best setup to take the trade. Even we can take trades on any reversal pattern that forms on this moving average. Just follow the same rules I mentioned earlier, like session timing, momentum, and confirmation. And if you also add volume to this strategy, it can increase your winning ratio even more. For example, if the volume at the bottom is high, it means buyers are stepping in strongly, and there's a high chance the market will give a winning move. In that case, you can set your take profit a bit wider with a smaller risk, because when the volume is high, the market usually keeps pushing even higher. If the market is in strong momentum, you should enter the trade right after the morning star pattern forms. Don't wait too long. But if the market is pulling back toward your moving average, then you need to wait for at least a 50% retracement, somewhere around the middle of the morning star pattern, before entering your trade. That gives you a safer entry with better risk to reward. Trade management in this strategy is actually a very interesting part. You can trail your stop loss after every single candle that forms above your 9-period moving average. As long as the moving average is pointing upward, it means the trend is still strong. So you can move your stop loss closer, or at break even, you can take your first take profit at a 1-to-1 risk to reward ratio. Now, most people will say that this is too low. But in reality, this is how trading actually works. Because here you're trading with momentum, and your winning ratio is already very high. That's why this is the exact and most practical way to trade. And this is also what makes this strategy perfect for beginner traders. There's almost no drawdown. If you just follow the rules properly, you can secure your profits easily and trade with full confidence. Use the 1-minute, 5-minute, or a maximum 15-minute time frame, and take only 1 or 2 trades a day on a single market. Always manage your risk and fix your stop loss before entering any trade. So that's it. That's the full strategy. If you want more information or a detailed breakdown, just comment details below and I'll make a complete video on it. I personally use this strategy, and it works great for me. Don't forget to like this video, subscribe to the channel, and I'll see you in the next one. Thank you.